Today is Wednesday, April 8th, 2026. Silver is at $76.45 per ounce, up nearly 5% in a single session, clawing back ground after weeks of relentless selling pressure. And if you are only watching those numbers, if a single-day surge is the only data you are tracking right now, you are watching the wrong signal. Because underneath that rebound, a story is forming that has almost nothing to do with today's ceasefire headline, and almost everything to do with a structural supply crisis that has been building for 6 consecutive years. The last time silver experienced this kind of peak-to-trough collapse followed by a sharp technical reversal, the metal did not simply recover. It broke to new highs. Today, I am going to show you exactly why this moment, this specific combination of geopolitical pivot, macro repositioning, and physical market stress, deserves your full attention. But before I do, I need to give you the full picture of what has been happening in the broader economy. Because a 6% intraday move does not exist in a vacuum. It is a direct consequence of forces that have been building for months in ways the mainstream financial media has been either unwilling or unable to describe accurately. Once you see those forces, the price action will make complete sense. And once it makes complete sense, you will understand why this specific moment is not a time to step back. It is a time to pay extremely close attention. Here is the signal. Earlier today, President Trump announced a conditional 2-week ceasefire with Iran. The deal includes a 10-point negotiation framework and, critically, the temporary reopening of the Strait of Hormuz, the waterway through which roughly 20% of global oil supply moves. That single announcement triggered an immediate repricing across commodity and financial markets. Oil pulled back sharply. Inflation expectations, which had been ratcheting higher for weeks, began to ease. And silver, which had been crushed by the weight of those inflation fears and the hawkish rate policy they implied, surged. Spot silver reached an intraday high of $77.64 per ounce, a level not seen since March 18th. Gold also rallied, crossing $4,836 per ounce. But here is what matters. Silver outperformed gold by nearly 3-to-1. That divergence is not a coincidence. It is a signal. What does it mean? When silver outperforms gold during a relief rally, it is typically because capital is rotating back into industrial risk. Silver is not just a monetary metal. More than 50% of its demand comes from industrial applications: solar panels, electronics, electric vehicles, medical technology. When energy-driven inflation fears ease, those industrial demand projections recover. And when industrial demand recovers, silver recovers faster than gold. Think about that for a moment. The metal that was punished most severely by the inflation trade is now the one being rewarded most aggressively by the disinflation trade. That is not arbitrary. That is a market telling you something about where the underlying demand structure actually sits. Now, here is the bigger picture, and this is where the story gets significantly more serious. Silver's intraday high today of $77.64 is still nearly 37% below its January 29, 2026 peak of $121.78. That peak-to-trough collapse, from $121 to a March low of $61.21, was one of the most severe corrections the silver market has experienced in a generation. Monthly historical volatility hit 37.59% for silver futures in early April, nearly double gold's 19.35% for the same period. The SLV which mirrors spot silver, fell 45% from its January high of $109.83 to a low of $60.37. Those are not rounding errors. Those are the kind of numbers that shake out weak hands, break momentum models, and force leveraged positions into liquidation. And yet, through all of that selling, the global supply deficit did not close. It widened. The silver market is now in its 6th consecutive year of structural supply shortfall. Demand from the solar energy sector has set consecutive annual records. Electric vehicle production is accelerating. Electronics and semiconductor manufacturing continue to consume silver at a pace that mining output cannot match. China's silver imports have remained elevated, adding sustained physical demand pressure on top of everything else. These are not speculative projections. They are documented, measurable structural realities. A 2-week ceasefire does not change them. A Fed pivot does not change them. The deficit is real, and it is growing. Analysts at J.P. Morgan have projected average silver prices of approximately $81 per ounce for 2026. That forecast was made with the understanding that short-term volatility, geopolitical shocks, inflation repricing, central bank policy swings would create noise around a fundamentally bullish supply-demand dynamic. Today's move towards $77 is consistent with that trajectory. But the J.P. Morgan projection is an average, not a ceiling. It assumes the structural supply shortfall continues. It assumes industrial demand holds. Both of those assumptions appear, at this moment, to be well supported by the data. The gold-silver ratio, which had widened dramatically during silver's correction, has begun to narrow again during this rally, a pattern that historically precedes periods of sustained silver outperformance. Here is what all of this adds up to. Silver entered 2026 at $71.59. It ran to $121 by late January, a gain of roughly 70% in 4 weeks, driven by a convergence of geopolitical risk, inflation fear, and industrial demand. Then a combination of energy-driven inflation expectations and a sudden hawkish shift in Fed rate outlooks reversed that move with extraordinary violence, pulling silver down nearly 37% peak to trough in less than 10 weeks. But the fundamental case, the supply deficit, the industrial demand, the monetary appeal, never changed. What changed was the macro overlay, and today, that overlay just shifted again. The ceasefire eased oil prices. Oil easing reduced near-term inflation pressure. Reduced inflation pressure reversed the hawkish rate narrative. And a more neutral Fed outlook, combined with a weaker dollar and lower Treasury yields, is exactly the macro environment in which silver historically performs best. A market that was sold aggressively for the wrong reasons, because macro conditions temporarily turned hostile, is now being bought for the right ones. The structural case was always intact. Now the macro case is realigning with it. That is when silver tends to move, not gradually, but decisively. This channel holds a straightforward view on silver, and today's session does nothing to change it. The structural supply deficit is real. The industrial demand from solar energy, electric vehicles, and electronics is not reversing. The monetary case for silver, in an environment of elevated debt and long-term inflation risk, remains firmly in place. A 37% correction from an all-time high, followed by a sharp technical reversal on significant volume, is not a reason for concern. For investors who understand what is driving this market, it is a setup. The 2-week ceasefire is temporary. The supply shortfall is not. As always, this represents the view of this channel only. Nothing in this video constitutes financial advice. Do your own research. Consult a qualified professional before making any investment decision.